Good morning, everyone, and a very warm welcome to the SRM 10th Anniversary Conference, hosted by the Single Resolution Board. I'm Susan Carroll, Head of Communications at the SRB, and it's my pleasure to guide you through the programme today. We're really happy to have you here with us in Brussels, despite the strike yesterday, as well as warm welcome to those following us online. Today is a very special occasion, marking 10 years of the Single Resolution Mechanism. We'll take stock of how far we've come, explore lessons from recent crises, and look ahead to the next phase of banking resolution in Europe and beyond. A little practical note before we start. The conference is being live-streamed via the SRB website, so especially for our speakers to take note, we are on the record. And please don't hesitate to share highlights on social media with the hashtag SRM10. So before we officially start, a little bit of information about our format. We'll start the day with a welcome from SRB Chair Dominique Laboureix, and we'll then be honoured with an opening address from European Central Bank Vice President Luis de Guindos. After that, we'll dive into the discussions with two high-level panels before we take a moment to celebrate this special anniversary. After a lunch break, we'll hear from Acting Chairman of the FDIC, Travis Hill, joining us live online from Washington, DC, and we'll then split into 3 parallel sessions. For those of you joining us online, all 3 sessions will be web-streamed, and of course, the whole conference will be available by video afterwards. After those sessions, we'll come back together in this room for our closing speech via video from Maria Luisa Albuquerque, Commissioner for Financial Services and the Savings and Investment Union at the European Commission. Now, let's get started. It's my great pleasure to hand over to our host, SRB Chair Dominique Laboureix.
Ladies and gentlemen, welcome to our SRM conference. This is a very special one, as Susan just told us, as we mark our first decade protecting financial stability in Europe and beyond. This 10th anniversary conference will be an occasion to recall the achievements so far, but more importantly, to discuss the way forward. Let me start from the achievements. Resolution, I mean its framework and the second pillar of the banking union, started from scratch. A series of theoretical elements built on the ashes of one of the worst financial crises ever. Nobody knew if a resolution could work. In addition, in Europe, we had to prove the value of a centralized authority in a network of national authorities. There were many doubters, but I think we proved them wrong. Together with the NRA's, National Resolution Authorities, we made the European Resolution Framework an effective reality, credible at home and abroad. We showed that it works. How did we do that? Most obviously, resolving the banks that needed it. Banco Popular, Sberbank are our landmark successes. 2 only. Fortunately, large banks' crises are rare enough. But in those rare occasions, we were not allowed to make any mistakes. Resolution, in fact, is a single shotgun. If we fail, trust vanishes and financial stability is in jeopardy. Also, no matter what we do in a crisis, litigation will follow. In fact, the development of case law has been critical in establishing the credibility of our framework, which with each case and each round of judicial review, we gain greater clarity, and that clarity helps us navigate the next crisis better. This said, successful resolutions are not our only contribution to financial stability in Europe. Beyond these landmark cases, there's daily work on real-time crises that often goes unnoticed. Over the years, together with the SSM, the Single Supervisory Mechanism, and the National Resolution Authorities, we've been working on a number of crisis cases. Some eventually did not lead to a failure. For some, we decided that resolution was not needed. I think this too is a relevant contribution. We reserved our very extensive powers to those cases in which there was no other viable way out. And even more behind the scenes, resolution planning quietly strengthened the entire system every day. Let me give you some figures that should give you the dimension of this constant resolvability progress in the 10 last years. More than 2.6 trillion euros of loss-absorbing capacity, what we call here in the European jargon the MREL, minimum requirement on eligible liabilities, built by banks in the banking union, 2.6 trillion euros. 80 billion euros for the Single Resolution Fund ready to be deployed. About 150 operational and actionable resolution plans drafted and updated every year for significant and less significant institutions earmarked for resolution. In addition, over the past decade, a new kind of professional has emerged in Europe, the resolution expert. Today, many are in this room and online. I can't give you an exact number for Europe of these experts, but I can say that we are many. We work in banks, obviously, in consultancies, in law firms, in academia, and of course, in public authorities. And many of us, especially the younger ones, have dedicated our entire careers to this endeavor. This is a new job, and this is a great achievement. Our dedication, your dedication, strengthens financial stability and makes Europe more resilient, globally speaking. Let me now tell you about the road ahead. I want to be clear. Regardless of our achievements, crisis management is, by its single nature, a messy business. Resolving banks will always be complicated, full of surprises, and to a certain extent costly, but not for the taxpayer. Cela va sans dire, as we say in French. That's why resolution and crisis readiness work is never ending in reality. The single resolution mechanism will need to change too to stay ahead. This is exactly our approach via our new strategy adopted already 18 months ago. We want to ensure that the single resolution mechanism is more effective and always focused on what really matters. This continuous improvement process is complementary to unifying the SRM working culture and converging also with the SSM1. Ideally, we should increasingly act seamlessly in a continuous process. Continuous improvement and focus on what really matters also imply a sensitivity to the famous word used everywhere in those days, simplification. In that sense, we've started working on ways to remove undue burden on the industry, for instance, by streamlining our resolution plans and thus our requests on the industry, or to better coordinate with other agencies to avoid double requests. But we can only be as effective as our framework allows to be. Our framework is strong, but it can be improved. Simpler rules could help. Of course, we have to make sure this exercise does not deliver loser standards. What I think is critical to bear in mind is that going concern and gone concern requirements are intimately linked. If discussions need to happen on those requirements, it has to be holistic. Of course, the Single Resolution Board stands ready to be part of this debate. Ultimately, strong crisis management capabilities should rest on a framework that is, as much as possible, simple, usable, and up-to-date. With CMDI, the reform on crisis management and deposit insurance, nearly finalized, co-legislators should look ahead, complete the banking union. One pillar, the European Deposit Insurance Scheme, is still missing from the original design. But a complete banking union is more than it is. It's also made of a number of other elements. We are still waiting for the signature of ESM treaty revision as an example. But much more than that. With one supervisor and one resolution authority after 10 years, I don't see many reasons to continue operating with internal barriers. But still, today, banks and authorities need to deal with too many discretions. A less fragmented market is definitely the best option for a simpler regulatory environment. Financial stability, though, does not begin and end with banks, and I would like to draw your attention to other actors. We need to stay ahead of new risks that banks may face. And now, more than ever, it's important to remember that business models and banks themselves evolve. New players emerge, and with them, new risks. Today, much attention is focused on the new entrants coming directly or indirectly into the banking activities. From banks' exposures to non-bank financial institutions to the development of the crypto world, it's becoming increasingly urgent to ask ourselves, has the time come to start exploring a crisis management framework for more of these actors, non-banking financial institutions? In recent years, the perimeter of resolution has expanded to include insurance corporations, central counterparties beyond banks. Yet, large parts of the NBFI sector still fall outside it. Some of the biggest NBFIs are now so large and so interconnected, and many either provide bank-like functions or do business with banks, that they have already become or are about to become too big to fail. So, normally speaking, that's the moment to find solutions. Ideally, these debates should first take place in global fora, and the first one is obviously the Financial Stability Board. And the SRB stands ready to play its part in these discussions. The cost of inaction would be significant. Sooner or later, one of these players will fail, with dire consequences for financial stability. We need to be ready for when that moment comes. That's the moment to conclude, anyway. As these are all topics along many more that we will be discussing in detail today, so I can stop quickly. I think that together with the NRAs, the SSM, I see Claudia in front of me here today, we've achieved much with our work of the 10 last years for financial stability while avoiding bailouts. We shall not rest on these good results, but remain vigilant, ready to improve and always on the lookout for new risks. This cannot be done in isolation. We should keep cooperating intensively in Europe and crucially with our partners around the globe. Aristoteles, a Greek European member of the Banking Union, as everybody knows, famously said, "In poverty and other misfortunes of life, true friends are a sure refuge." And banks' crises are certainly misfortunes of our economic lives. This is why I'm so glad to see so many of our friends among our speakers and guests today. Thank you for your attention.
Thank you very much, Dominique, for setting the scene so powerfully for our discussions today. We now move on to our opening address, and please join me in welcoming Luis de Guindos, Vice President of the European Central Bank. Unfortunately, due to the strike yesterday, the Vice President can't be with us in person, but kindly joins us online from Madrid. Vice President, good morning.
Good morning, and thank you very much for the invitation. I hope that you can hear me and you can see me.
Thank you.
I am delighted to take part in your conference today to celebrate the 10th anniversary of the Single Resolution Mechanism, with much regret for not being able to be with you in person. A decade ago, the SRM was established as a direct response to the global financial crisis and the European sovereign debt crisis. As the second institutional pillar of the banking union, it has the ambitious remit of improving how bank failures are managed while safeguarding the public interest, and limiting recourse to taxpayer money. Together with the single supervisory mechanism, it has played a pivotal role in protecting financial stability in the EU. 10 years on, we once again find ourselves in a challenging environment, marked by significant uncertainty and geopolitical risk. The banking union remains incomplete, as Dominique has indicated, at a time when the EU needs to uphold its fundamental values and defend its interests. We cannot wait until the next crisis to move towards strengthening the EU project. Looking back at the past decade, the banking union has been a major success for Europeans. The banking sector is now much more resilient than it was 10 years ago. The pandemic and Russia's full-scale invasion of Ukraine affected many parts of our daily lives, yet the banking sector remained strong. The pandemic brought the economy to a virtual standstill, while Russia's invasion was followed by an unprecedented surge in inflation, which called for an equally unprecedented period of monetary policy tightening. The banking sector proved resilient to those two shocks, managing to restore profitability and adapt swiftly as we emerge from the low interest rate environment. Over the past 10 years, the SRM has helped strengthen the banking sector and prevent systemic crises. It has brought about something that was once unthinkable, a European approach to bank resolution. Through the SRM, you have overseen the build-up of liabilities to absorb losses and recapitalize a banking resolution. You also set up an 80 billion single resolution fund for the orderly resolution of banks in more challenging scenarios. The SRM has shown that decisive European action can ensure the continuity of banks' critical functions without causing severe economic disruption. A case in point is Banco Popular in 2017, one of the first instances of a bail-in, and despite the expected judicial disputes, one that was carried out on solid legal grounds. The SRM's smooth handling of resolution cases, which I witnessed firsthand as economy minister in Spain during the Banco Popular resolution, sends a very powerful signal. Europe has the tools and determination to manage banking crises successfully. Since 2015, we have invested significant effort in ensuring that the ECB and the Single Resolution Board work together seamlessly at all levels, including through data sharing and various dry run exercises that are critical to advancing resolution preparedness. However, we cannot rest on our laurels. The banking union is still incomplete, and much work lies ahead to ensure that banks can operate in a true single market and reap economies of scale. For this, we must recapture the mindset that enabled us to create the banking union. This means recognizing the magnitude of the challenges ahead and understanding that only by acting together as Europeans and rising above national interests, we can address them. Let me start with the actions we need from legislators to ensure meaningful progress towards completing the banking union. First, while the Single Resolution Fund is ready, its backstop, to be provided by the European Stability Mechanism, is still missing. If we are to be prepared for bank crisis, this gap must be closed by finalizing the ratification of the reformed ESM Treaty. Second, we need a European framework for liquidity resolution. After resolution, the availability of liquidity support is often indispensable for restoring market confidence in a bank. Third, a European Deposit Insurance Schemes, EDIS, remains crucial for ensuring a cost-effective and harmonized deposit protection system. EDIS would also help address the bank sovereign nexus. We look forward to seeing renewed efforts by co-legislators to move forward on EDIS. This is urgently needed. Let's get it done. These issues have been on the table for a long time now. I am optimistic that we will see progress. First, because they are essential for the EU project, and second, because their ultimate goal is to protect the banking system, savings, and access to finance in the Union. The recent agreement on the reform of the crisis management and deposit insurance framework is an important step forward, but it does not replace EDIS. I do, however, recognize the politically contentious nature of the topic and co-legislators' work in hammering out the necessary compromises to improve EU rules for bank crisis management. but more remains to be done. Mario Draghi's report setting out recommendations on how to boost European competitiveness was published over a year ago. But the proposals put forward by Enrico Letta in his report on the future of the single market are no less important. The single market, one of the EU's greatest achievements, is a cornerstone of prosperity and resilience, but it too remains incomplete in some respects. By removing the barriers to cross-border economic activity and fostering even deeper economic ties, we can lay the groundwork for financial market development and greater investment across national borders. For the banking sector, completing the banking union, of which the resolution framework is an integral part, would lower barriers to cross-border business and promote the flow of financing to high-productivity firms in the union. Improving the free flow of capital and liquidity and facilitating cross-border mergers within the banking union should be an urgent priority. The national ring-fencing, which at present severely limits what European banks can achieve. But more fundamentally, removing obstacles in tax, insolvency, and corporate law are essential to fostering cross-border economic activity. At the same time, the costs associated with the lack of harmonization in securities trading and post-trade services in Europe may also be stifling the growth of our capital markets. The average costs for settlement and safekeeping borne by market participants are higher in Europe than in the United States. Our regulatory, supervisory, and market practices create barriers that make it difficult for markets to scale up. They also expose securities issuers, intermediaries, and investors to uncertainties and high compliance costs. Harmonizing aspects of the debt issuance process would address such frictions. This would make the EU capital market much more attractive for investors and strengthen the international role of the euro. But decisive action to advance the European project requires a European institutional framework that preserves stability and fosters greater integration. More integrated supervision of EU capital markets will be key in this endeavor. European-level supervision provides the tools and the broader perspective necessary to safeguard financial stability, because systemic risks don't stop at national borders. EU-level authorities should also be better equipped to foster integration across borders. This doesn't need to happen all at once. Naturally, introducing new powers for the European Securities and Markets Authority, taking into consideration the specific traits of each sector, will be crucial in building its capacity while maintaining the central role and expertise of national authorities. Finally, we should also critically assess how we can further improve and simplify our regulatory and supervisory framework. Many EU authorities, the ECB and the SRM included, are currently working intensively on simplification. We are strongly in favor of reducing undue complexity, administrative burden, and overlaps, as long as resilience and compliance with international standards are preserved. As prudential and resolution requirements interact with one another, collaboration between authorities is key. Reporting overlaps may, to some extent, be unavoidable, but we can reduce the burden by establishing an integrated reporting system that will be accessible to the relevant EU authorities. Let me conclude. The SRM's mission 10 years ago was clear: ensure that failing banks are resolved in an orderly manner, without resorting to taxpayer money and without increasing risks to financial stability. Born out of a crisis, the SRM has delivered. For the past decade, it has helped to shield Europe from financial turmoil, and in the process, the SRB has become a trusted international partner in crisis response. The next 10 years will undoubtedly bring new challenges. At the ECB, we look forward to continuing our work with you to make the SRM's next decade as successful as its first. But let's not be complacent. Let's strive for strong European solutions. Completing the banking union and building a strong savings and investment union will contribute to an even more resilient banking sector that supports productivity and growth. This, for sure, will benefit all Europeans. Thank you very much for your attention.